Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's going on. First of all, the US dollar index is trading below the 20-day moving average. The gap's right below. We have around a 70-cent pullback on the dollar index. To put it into perspective, that's around 70 pip loss for those US dollar index traders on the foreign exchange. Again, this is just typical market behavior. I don't know how to, I stress this a lot. We are pulling back from the upper ends of a trend. So the trend wasn't able to sustain itself, at least not in the meantime. What happened on Monday, or more like Tuesday, because Monday the U.S. markets weren't open because of the New Year holiday. I really don't like holidays. But you know what, I guess everybody needs a break, including myself. But I prefer trading, prefer working. But basically, the Italian government bond yield pulled back to around 6.92. We were able to pull back from the 7% area. And that's what has given the Euro-US dollar a nice little boost. And that's also what's giving the gold and silver market a nice little rally. As you guys can go ahead and tell us, the Euro-US dollar has been able to break right above the upper channel. And right now, we're just having this channel trade right here. Nice little break right above it. I think that if we can sustain above this and the euro and the Italian bond yields continue to drop, we can see a continued rally. Main reason why we're having a rally on the Dow component, though, is because of the fact that we are in earnings hype. And earnings hype, this is how earnings hype works. Okay. Before earnings are ever announced from any major Dow component stock, what we do on Wall Street is we buy stocks in anticipation of future results that are proposedly or supposedly better than what has been the past. And once earnings have been announced, we sell the asset, or we sell the asset right before earnings are announced. Now, some people like to hold even after earnings, some people don't. Okay, but what's really happening right now is an earnings-fueled rally, and that's what I kind of pointed out in the video prior to the one where I talked about the short-term pullback that was in place. We got our short-term pullback. It really didn't amount to much. And right now, we're going to have to trade for the longer term, perhaps a month or so worth of gains. Again, I believe by the end of January, markets will pull back again. It's going to be a cyclical pullback, mainly because of the fact that earnings are announced, stocks go up. Okay, once earnings are finished, we pull back. That's just the way markets work. We like to buy into hype, and then we sell the news. Rinse, repeat, rinse, repeat. But that's that's how we trade markets. Now, under certain circumstances, you might have, effects or market effects. Okay, so effects, stuff that happens to the market. Perhaps the U.S. Treasury is going to default on their loans, or European governments start going haywire because they can't pay their bills. Okay, stuff like that. That's kind of the stuff that causes markets to go, all over the place. But for now, when I trade markets, the way I'm thinking of it, at least my logic that goes behind this, is we're in earnings season. Earnings hype is going to cause stocks to rise. Italian bond yields are dropping. Therefore, the US dollar index is having a sizable pullback. The Euro-US dollar responds to that extremely favorably by rallying. And the same thing happens in the Euro-Japanese yen chart, albeit it was able to hold above $100 on a day trading session for a moment of time. But it did pull back towards the night session. Again, we're going to have to watch the Euro-Japanese yen very closely, and we're going to have to see the Italian bond yields very closely. Hopefully, the Italian bond yields continue to drop. Euro-Japanese yen continues to drop, or continues to rally for at least the short term, stay above 100 for a little longer before something else happens out of Europe that will derail a market rally. Now, moving on, I do want to talk about my silver and gold exposure. I did have to close my silver short. I got flushed, just like every other short trader got flushed on Monday, or more like Tuesday. Wednesday, okay, so Tuesday session I get flushed, I close my position, and I'm watching the chart very closely to see us break out of the channel. Gold has already broken out of its channel on January, I believe. January 2nd. Okay, so gold has already had a nice little break right above. Okay, so for the last couple, 3 sessions, gold has been able to prove itself to break out of its own respective channel, and therefore gold is in pretty good territory for now. So I anticipate gold to eventually rally up a little bit and perhaps hit that 200-day moving average, trade around 1,650. At least that's my price target. If it doesn't get there by the end of January, you'd have to close your positions because again, we're riding on stock market earnings hype. And stocks are paired to the dollar index. The main reason why this matters is because we're kind of in asset circulation mode. We go from this asset to that asset, this asset to this asset, that asset to this asset. So you really have to keep an eye on the macro aspect of everything. So the main reason why I'm saying, pull back your exposure to gold after the 200-day moving average is because that's about as high as we'll probably get in the month of January. Okay? Now, we could go above that, but I mean, if you get a $50 gain on a futures contract, or you're trading leveraged gold ETFs or stuff like that, a $50 rally, let's give them give or take like 2.5%, 3% gain. Not bad if you're trading a leveraged gold ETF. Maybe it might even go higher than that. Who knows? I mean, we're not exactly certain because the future hasn't been written yet. But I do think the 200-day moving average is the most realistic assumption to make before it reaches and it has a hard time breaking above and before it feels some resistance. So again, we have a strong rally in place. 1,650 will be strong resistance. So watch it very closely. Okay, moving on. Silver. Same story here, except now I'm just going to have to wait a couple days. I was just like, forget it. I'm going to close my short position, lost some money. Oh, well, we'll watch. Oh, wow, look, 15% rally in the AGQ. Silver rallies by 6%. It's running into the upper end of its channel. We'll watch it a couple days. Italian bond yields are dropping. We're running into the risk-obsessed session where everybody's buying into earnings hype. Earnings hype is what's causing assets to reflate. Reflation means assets like silver should rally. Therefore, I'm going to have to wait and see what happens. Perhaps you can break above that upper trend line. If so, I'm aiming for a $35 price entry or price exit. To be more exact, I want to exit out of my silver long position at around $35 per ounce on spot silver, which I'm not exactly how that translates onto the AGQ or the 3 times leveraged silver ETF. But right now, I'm going to watch for the $35 silver exit. So once it gets up to $35 per ounce, that's going to be the 200-day moving average or somewhere around the 200-day moving average up to that upper channel. We break, we hit that area, chances are I'm going to close. I think that's the biggest move I could anticipate coming out of silver in the month of January. So that's as much time as we'll probably have. I mean, giving it's just a month time frame. And the only reason why I think we'll get there is because of earnings, the earnings fueled rally. Italian bond yields are dropping temporarily, and the euro-US dollar is breaking out of its channel on the bottom end of its chart. Moving on, let's talk about some stocks right now because that's all the time we'll have. Perhaps one company, Deckers Outdoor. I'm thinking of buying into this bottom area, 76.30. I think that we're going to have a nice bounce, mainly because of earnings rally or earnings season. Earnings season is what's going to cause stocks to go up a little bit. And, my mentality is perhaps we're going to have some risk appetite come back into the marketplace. If we get some of that risk appetite, stocks like Deckers Outdoor that trade at higher earnings, PE multiples, will have to get a decent rally. Therefore, what happened to my stocks is I had to close my Amazon short position, I had to close my FAS short position, because I figured, hey, you know what, people want to take on some risk, fine, we'll ride this market upwards for the short term. Again, my long-term economic outlook is pretty negative, but for the short term, I still believe stocks will have a nice little rally because of earnings, earnings-fueled hype. And if that's the case, we want to buy into the hype. And right now, Deckers Outdoor is trading at the bottom end. It has a reverse hammer pattern, which is indicative of a market ready to reverse. We're at the $75 double bottom area. Chances are we're going to bounce. We're going to hit $85. We're probably going to break above that gap area and perhaps right into that 200-day moving average. And then there's another gap area. So this is our target exit zone above $85 and below $95. Anywhere between that area would be around a 10 to 20% gain after buying at $76 per share. My realistic assumption is somewhere around $89, $87, perhaps a 15-14% gain on the long trade with Deckers Outdoor. So that's the chart that I'm really looking out for. Again, there's a lot of other great setups out there I'm well aware of. However, we don't have enough time to talk about every single type of setup that's going on. And there's only so many opportunities you can really invest into. So we're just going to give it some time. We're going to trade the short terms. Long-term fundamental outlook is still negative. Bond yields are pulling back a bit. That's what's causing the euro to rally. As long as that correlation holds, which it most likely will, and if the Italian bond market continues to pull back, as long as Italian bond yields continue to pull back, which means Italian bonds are appreciating, that will be good. That will give the euro-US dollar all the support it needs to continue going higher, and therefore stocks will continue to be bought, commodities will continue to be bought, and what adds to this rally is earnings season. So we got earnings season, we got bond yields, bond yields pulling back a little bit, we got the euro-US dollar rallying, dollar index is pulling back. That's all very indicative of a market that's ready to return and gain some yield, at least towards the front end of 2012. I hope that helps you guys. I think, my longer term outlook might have overshadowed what we want, at least in the short term, which is to make yield, make money. And right now, the best way to make money, and in my belief, is to reallocate capital. It's to go along the stock markets, at least for the short term, and commodities will get a nice bounce, okay? So take care, folks. If you have any questions, I'll try and help you guys as much as possible. Leave a question below. I'll get back to you as soon as I can. Thanks a bunch. I appreciate it. You guys have a great trading session on Wednesday.